Welcome to a thought share on what to expect from your investments in this calendar year 2025 and probably early 2026 also. 2025 has begun with a surprise for many investors because having seen only positive returns in the last 2 years, when you see a previous month statement to current statement, you would have seen a profit getting added into the account. While in the last 4-5 months from October onwards, it has been negative. This has caused concern for investors. While is it serious? Not at all, because the last 2 years returns have been very big. Generally, thumb rule in the market is bank rate into 2.5 times is the average return the market can give. So our bank rate until RBI cut the rates on Thursday, it was around 6.5%. If we take that, market return on an average per annum should be 16.25%, while 2023 gave 35%, 2024 gave 25%. In the 2 years preceding 2025, we have made 60% returns, while it should have, if you say, take it as 16.5, it should be around 32%. The excesses what we have gained in the last 2 years is what is giving up now. So by the end of 2025, it should average out. So if suppose we have invested 100 rupees and for 3 years at 16.25, our return should be 57.1%. That is 100 rupees would have become 157.1. Today in 2 years itself we have made 160. This 3% difference is getting adjusted. It will happen over the period of 2025. If suppose 2025 manages to close positive, that excess will continue even in 2026. That is why I told early part of 26 also can have some challenges. So where are we now? From the time we started correction in October, September was the peak. From October, markets have dropped between 11 to 13%, on an average around 11%. If we take the calendar year from January onwards, drop is somewhere around 5% on an average. If some portfolio is having small and mid cap, more of small and mid cap exposure, maybe 7 to 8%. That is the drop we have had. So majority part of the correction is over now. Maybe another 2 to 3% can go down. That will also get stretched for a longer period, maybe another 10 to 12 months time. So this market has become one. There are two messages that we have now. One is correction is almost over, downside is more limited now from here. And the second message is market is getting into a buying zone. It is because it's going to stay here for 10 to 12 months. It is right time to put bulk money as well as increase SIPs. Yeah, biggest advantages for SIPs only because this staying period is quite longer. The unique situation that we have in the market, which is advantages for SIPs, will help investors to get more units for at least 12 to 15 months because we are staying low. Whatever money we invest into the market, we get higher number of units compared to what we got prior to this correction, that is in September 2024, prior to that. So this accumulation will help us to have better returns when the market goes up again. It's not that we have bottomed, current price only we will buy. Sometimes it can even go a little lower. That is actually an advantage because as lower it goes, it will come back to the mean. So by participating through SIP, if the market is low, we get even more units, which will help us to generate additional returns when the next upside happens. So if you are having some surplus money, this is good time to invest into the market and also increase your SIPs. SIPs is must because this opportunity doesn't come every time. Once in 2-3 years only we get this, and if we build up on this, it will help us to generate additional wealth creation for us itself. Generally, after a correction, after the market starts coming down from the top, there will be a perception with people fear that will it be right to buy now? Will it go down again further? So we have talked about what is the downside impact which is going to have in the future and what we have had already. Most of it is done. So what are the challenges that we have which can put pressure into the market? First is FII selling. The media has been talking heavily about FIIs been selling our market. Billions of dollars have gone out of the market. Yes, FIIs have been selling. One advantage what we had, unlike what we used to have earlier, is the domestic money which has come enormous into the market has supplied money to the FIIs. All the selling by FIIs got absorbed. That is why our drop is only 5% from January onwards. Otherwise, our drop would have been heavier. Another advantage is FIIs are moving out at dollar exchange price of 83. By the end of this year, dollar is likely to be at around 90. We are already at 87. So they are going to come back at 90. Already they have lost nearly close to 10%. And when they come in, that will actually trigger the market to go up. So this is actually a place which is very, very attractive. FIIs have vacated the market. When they come in, they will come because India is the only market which is having highest growth in spite of we having lower tick on the GDP. So FIIs moving out has actually become an advantage at current level. When it was happening, it did have an impact. Second one is tariffs. Again, after Trump came, Trump tariffs have been in the news every day. Every article will have Trump tariff. While tariff will not, it's actually only a threat game to bargain and do some business. Otherwise, they are not going to achieve anything. Taking back manufacturing to US. In fact, I was also having that opinion. Why not in US or all the countries manufacture their own products on themselves so that not depend on import. This problem will not be there. But I got some gyan from a fund manager which was very, very relevant. In US, per capita GDP is above $70,000 per person. Whereas the developing countries like India, Philippines, Vietnam, we are at around $2,500 to $3,000. For manufacturing to move to America, it is next to impossible. They can't pay $70,000 salary and produce a product which is less than what the developing nations, the emerging markets can give them. So these tariffs, they have to accept it. Maybe small bargains will happen. They might sell some weapons to us because that is what they are good at. And some products like Harley Davidson kind of things. Whereas in this activity, India is very, very proactive. When US said we will send 18,000 people to you back, deport, we said okay, we will accept. Even before they could ask, we have cut tariffs on whatever US imports we are having. So we are in the good books of the US. Next is consumption is slowed down. Our GDP is ticked down in the last print number. The talk is urban consumption is not that people are not buying goods. This again is got resolved by the budget where they gave around 1.1 lakh or about 1 lakh crore of extra money is given into the middle class people's pocket. This money will not directly go into buying soaps, detergents and toothpaste, but it will go into buying consumer durables, which will generate 1 lakh crore over a period of 3-4 years is what mostly they will be buying in EMIs. This will generate around 3 to 4 lakh crores of business in the economy. Whereas currently we are having around 300 lakh crores, this another 4 lakhs getting added, it will tick up a GDP itself by 1.25%. Then RBI has cut rates. Both actually became a very, very positive. One budget tax cut and RBI cutting interest rate. Interest rate cut from 6.5 to 6.25. Of course, this will impact the market returns because at 6.5% interest rate, we were having a 16.25% returns on the market, average return. When it goes to 6.25, we will be little above 15%. But still, 15% is fairly good because at 15% every 5 years, we can double your money. This cutting of interest rates will bring liquidity into the market. People will have more money, borrowing power. Both people and the companies will start borrowing more. Already, lot of companies have announced expansion because there is a surge expected in the mass market consumption of consumer durables. So all the things are actually positive. And one more advantage is this budget tax cut and rate cut by RBI is not going to be giving overnight shift to the market. It will take time because companies have to put capacities which will take at least 6 months, and from there showing numbers on the balance sheet will be another 6 months. So this is where this next 12 to 15 months is going to be a lucrative period for accumulating more investment into Indian market. I will give an example of when such things happened earlier. From 2017, if we take often we keep getting this kind of opportunities in the market. In the recent 7 to 8 years period, if we say 18 and 19 was a down market, 22 was a down market. If suppose somebody had put a 10,000 rupees SIP into the market in 2017, started with a 10,000 rupees SIP, today that investment would have accumulated. You have invested 9.8 lakhs, 98 months have passed. 9.8 lakhs would have been invested. The value of that investment today is around 20.5 lakhs. That is the same 10,000 SIP continued for 98 months. In case the person who is doing the SIP intervenes, taking advantage of these down market situations where there is a stagnation both in 2018 and 2022, the investment would have increased from 9.8 to 12.56, around 2.75 lakhs of more investment would have got into the asset, and the returns from 20.5 became 25.24. 4.75 lakhs more returns. Just by doing this activity, 2 lakhs additional profit was generated. Similar kind of situation is what we are having in 2025 now. Again, this opportunity, when we miss it, will come for maybe next time will be maybe 28 or 29. So for adding more returns, increasing SIPs now to participate in this consolidation that's what happening in the market is very, very good. If you are looking to increase SIPs in your account, please send us a message or a mail. We will do the transactions for you. Let us travel with patience, going through this journey of consolidation to create more wealth. Thank you.